If you think the bond market is boring, listen closely. One quiet move just sent an $847 billion warning signal through Wall Street, and almost nobody is talking about it. When Goldman Sachs starts unwinding U.S. bonds, it's not a trade. It's a message, and it's one the market ignores at its own risk. On the surface, everything still looks calm. Stock indexes hover near highs. Headlines talk about soft landings and controlled inflation. Treasury auctions still clear. But beneath that calm, something far more important is happening. One of the most connected institutions on the planet is stepping back from U.S. bonds at scale. And that should immediately raise a question in your mind. Why now? Goldman Sachs doesn't make emotional decisions. It doesn't chase headlines. It moves when the math, the flow data, and the risk models line up. So when reports and filings point to a massive unwind across U.S. Treasury exposure, roughly $847 billion tied to positioning, derivatives, and balance sheet exposure, this is not about a short-term trade. This is about structural risk. To understand why this matters, you have to remember what U.S. bonds actually represent. They are not just debt. They are the backbone of the global financial system. Treasuries are collateral. They sit under repos, derivatives, bank reserves, pension funds, insurance books, and foreign central bank balance sheets. When confidence in bonds wobbles, everything built on top of them starts to wobble too. For years, bonds were the safe place. If stocks fell, bonds rallied. If fear spiked, money ran into treasuries. That relationship defined portfolios for decades. But something changed after inflation came roaring back. Bonds started falling at the same time as stocks. The so-called risk-free asset suddenly wasn't protecting anyone. Goldman saw this early. Rising yields don't just mean better returns. They mean falling prices on existing bonds. And when you're sitting on massive inventories, even small moves matter. A 1% move in yields on long-duration treasuries can translate into enormous mark-to-market losses. Now scale that across hundreds of billions, but this isn't only about losses. It's about liquidity. The treasury market is supposed to be the deepest, most liquid market on earth. Yet over the past few years, cracks have appeared. Flash rallies, sudden yield spikes, auction tails, moments where buyers simply step back. When liquidity thins in the safest market, it's a red flag for everything else. Goldman's unwind signals a deeper concern. The supply of U.S. debt is exploding. Deficits are no longer occasional. They are permanent. Trillions in new issuance have to be absorbed year after year. The old buyers are less reliable. Foreign central banks are not accumulating treasuries the way they used to. Some are outright selling. Domestic banks are constrained by regulations and capital rules. That leaves the market increasingly dependent on price-sensitive buyers. Price-sensitive buyers demand higher yields. Higher yields mean lower bond prices. Lower prices mean balance sheet stress. It becomes a feedback loop. Goldman isn't waiting to see how bad that loop gets. It's stepping away before volatility turns into disorder. There's also the policy problem. The Federal Reserve is stuck. Cut rates too soon, and inflation risks reaccelerating. Keep rates high and debt servicing costs explode. Every percentage point increase in yields adds hundreds of billions in interest expense over time. Markets know this. Goldman knows this. And bonds priced at risk relentlessly. When a firm like Goldman reduces exposure, others notice. Not immediately, not headlines, but in positioning reports, funding markets, and derivatives pricing. This is how big shifts start. Quietly, rationally, long before panic. The real question isn't whether bonds will collapse tomorrow. That's the wrong way to think about it. The real question is whether the old assumptions still hold. That bonds will always be there. That liquidity will always appear. That the government can issue unlimited debt without consequence. Goldman's actions suggest those assumptions are under serious pressure. Is not something markets handle well when it builds slowly and then releases all at once. This is where the story gets uncomfortable, because the bond market isn't just reacting to inflation or interest rates anymore. It's reacting to credibility. For decades, the U.S. benefited from an almost unquestioned trust. Trust that treasuries would hold value. Trust that the dollar would remain dominant. Trust that policymakers would step in before things broke. That trust allowed deficits to grow without immediate consequences. But trust is not permanent. It's conditional. And Goldman's behavior suggests that condition is being reevaluated. Think about how bonds are actually used inside the financial system. They're pledged as collateral for short-term funding. They sit inside leveraged structures. They backstop derivatives trades worth multiples of the actual bond value. When bond prices fall, the collateral value falls with them. That triggers margin calls. Those margin calls force selling. Selling pushes prices down further. This is not theory. This is how stress spreads. Goldman Sachs lives at the center of this web. It sees funding desks. It sees repo markets. It sees derivative hedging flows. It sees when counterparties start to hesitate, when haircuts quietly rise, when financing terms subtly tighten. You never hear about these things on the news until it's too late. Institutions feel them long before the public does. And here's the key point most people miss. Goldman doesn't need a full-blown crisis to justify unwinding bonds. It only needs the risk-reward equation to tilt. If upside is capped and downside is open-ended, a decision is simple, especially when safer alternatives exist. Short-duration instruments, cash equivalents, even selective SK in other asset classes where volatility can be managed. The $847 billion figure matters because of scale. This isn't one desk, it's not one trade. It reflects a broad repositioning away from duration risk, away from long-dated promises that rely on stable inflation, stable growth, and stable policy. None of those look particularly stable right now. Look at the political backdrop: massive spending bills, aging demographics, rising entitlement costs, defense spending pressures, all funded by debt. Markets are starting to price not just inflation risk, but governance risk. Not default in the dramatic sense, but dilution, paying back in weaker dollars, rolling debt endlessly at higher yields. That's still a loss for bondholders. Foreign buyers understand this. That's why some have reduced exposure, not out of hostility, but out of prudence. Central banks diversify quietly. Sovereign funds rebalance slowly. Goldman is simply faster and more transparent through its filings. There's also a psychological shift underway. Younger investors don't see bonds as safe. They saw bonds crash alongside stocks. Pension funds had their worst year in decades. The 60-40 portfolio failed publicly and painfully. Once that mental anchor breaks, demand dynamics change permanently. Goldman's unwind reflects that shift. It's adapting to a world where bonds are no longer shock absorbers, but potential shock transmitters, where volatility in yields matters as much as direction, where liquidity risk is priced alongside credit risk. And here's the uncomfortable truth: if yields keep rising, something eventually has to give. Either growth slows sharply, or inflation spikes again, or the Fed intervenes more aggressively. None of those outcomes are friendly to long-duration bondholders. Goldman is not betting on a clean outcome. It's managing exposure to messy ones. This is why you shouldn't dismiss this move as routine portfolio management. It's a signal from inside the system, a sign that the smartest risk managers are preparing for instability, not calm. For adjustment, not normalization. The market hasn't panicked yet. It rarely does at this stage. It drifts. It rationalizes. It finds narratives to stay comfortable. But beneath that surface, positioning is changing, capital is moving. And when enough big players step back at the same time, the absence of buyers becomes the story. That's when yields don't just rise gradually. They gap. They jump. And suddenly everyone is asking the same question Goldman already answered months earlier. Then the headlines, earlier than the panic, earlier than the forced selling. And that timing is everything, because markets don't break when everyone is scared. They break when confidence quietly disappears and no one is left on the other side of the trade. This is where the $847 billion signal becomes impossible to ignore. Goldman Sachs isn't predicting a dramatic collapse, it's positioning for a regime change. A world where U.S. bonds behave differently than they did for the last 40 years. Where higher debt levels mean structurally higher yields. Where volatility is normal, not exceptional, where liquidity has a price, and sometimes simply isn't there. Think about what happens if this view spreads. If more large institutions shorten duration, if pension funds demand higher yields before committing capital, if foreign buyers stay cautious, the Treasury still has to issue, auctions still have to clear. The only variable that can adjust fast enough is price. And price, in bond markets, moves through yield. Higher yields don't stay contained in bonds, they flow into mortgages, corporate borrowing, commercial real estate, government budgets. Every corner of the economy feels it. This is why bond markets are so powerful. They transmit pressure silently, relentlessly. Goldman's move also tells us something about the Fed's limits. Central banks can influence short-term rates. They can signal. They can buy assets. But they cannot easily control long-term credibility. If markets demand compensation for inflation risk, fiscal risk, and policy uncertainty, yields rise despite guidance. We've seen this movie before. It never ends gently. Some will argue this is just tactical, that Goldman will buy back bonds later at better prices, that this is normal balance sheet management. Maybe. But even if that's true, the message doesn't change. The biggest players believe there is more risk ahead than behind. And in markets, percep, tie-in becomes reality faster than fundamentals. For individual investors, this isn't about copying Goldman. It's about understanding the environment. Blindly assuming bonds will protect you the way they used to is no longer a strategy. It's a hope. And hope is not a risk management tool. The uncomfortable realization is this: the U.S. can still pay its debts, but the cost of that debt is rising, and someone has to bear that cost. Bondholders are realizing they might be the shock absorber again, just in a different way. Through purchasing power loss, through volatility, through opportunity cost, Goldman is stepping aside because it can. Because it sees the plumbing. Because it understands that when the safest asset starts acting unstable, the smartest move is caution, not complacency. And this is why the $847 billion unwind matters. Not because it guarantees a crash, but because it signals a shift in how risk is being priced at the very core of the system. When the foundation adjusts, everything built on it has to adjust too. History shows us that the most important market signals rarely come with sirens. They come quietly, buried in filings, flows, and positioning changes that most people ignore. Goldman Sachs, Unwinding U.S. Bonds is one of those signals. It's not fear, it's foresight. A recognition that the rules are changing, that old assumptions no longer hold, and that safety itself is being redefined. Markets may stay calm for a while. They often do. But calm does not mean stable. It means balanced on confidence. And confidence, once questioned, is very hard to restore. The $847 billion signal isn't telling you what will happen tomorrow. It's telling you how the smartest players are preparing for what could happen next. And in finance, knowing that difference can mean everything.